Hey, what's up, guys? How's it going? I am back again to do a live training with you. So I know this was unannounced. I don't know if anybody's going to be on, but hopefully you can catch this video a little bit later. So what I'm going to talk about today is 3 big mistakes that I see Gen X and Gen Y investors make. So Gen X and Gen Y, that's typically the 25 to 45 year olds. These are the things that I'm seeing when I'm working with people. So I want to give you guys some good info, some things to watch out for, and how to become a really smart, intelligent investor. Okay, so we're going to do a training on that today. The system's a little funky with the way it's working, but hopefully it works out well, and this turns out the way I want it to turn out. So if this turns out well, I would love to do these trainings at least on a weekly basis going into next year. So I was going to wait till January to start these, but I figure why not better? What better time than now? So let's talk about this. So younger investors, man, I meet a lot of people that really want to be good investors. They want to do the right thing. They go seeking help. They listen to people on radio shows and they say, oh, go do this or that. And what I see a lot of times is people end up getting into either things that aren't investments or they're just bad investments, and there's so much better ways to do things. So what I want to do is just give you 3 things today to help you out, that you can go back and look at your own stuff, to make sure that you are doing, at least pretty close to what I'm going to teach you here, okay? So it may not be perfect, but that's okay. So let's see here. Looks like we're live. Looks like it should be going, all right? So let me get to my screen here. And let me make this window a little bit smaller so that you can still see me. But I'm not taking up the whole thing here, so let's see if I can do that. All right, I'm going to go hide over here in the corner. All right, so you can still see me, but hopefully you can just see the slides a lot better. All right, let's see here. Okay, so 3 mistakes investors make. Let's talk about that. All right, so if I can get in front of this. Dang, I don't know if I can get both on there. Let's see. Make me small, and then I'll move this over just a little bit. Let's see. All right, so let's try that. Okay, so the first thing that I see younger investors making a mistake of is they seriously don't put their money into anything that's even like a real investment. Okay, so what does that mean? Let me ask you first, does this sound like you? You want to get started with investing, and you have a friend or family member that helped you get started. And they told you they recommend an awesome product because it has life insurance and an investment in one product. It's called something like whole life insurance or cash value, so that could be universal life, variable life, something like that. Does that sound like you? Can anybody relate to that? If you can, this is not good, okay? So many people I see and meet, especially younger people, they have a friend that works at a company that usually has the word mutual in it, okay? You can just infer what you want from that. But the word mutual in a company name, typically they're going to try to sell you a bad product. I see it all the time. Like, I've looked at almost all their products and I haven't seen anything that I like that I don't think you can get a better deal somewhere else. So that's a nice thing. So for those of you that aren't that familiar with me, I do have a financial planning practice, but I am a fee-only and fiduciary, which means fiduciary means I have to put your best interest first, which means I don't sell products, I don't make commissions, I strictly work in your best interest. When people are selling these products, these life insurance / investment products, typically they're going to make a big commission, which is why they want to sell it to you. And if you're younger and you don't have a bunch of assets yet that they can make money off of, this is a way for them to make some quick cash off of you, but it's honestly not good for most people, like 99.9, okay? And especially if you're young, you do not need something like whole life, universal life, variable life. You just don't need those things, okay? So why is this not good? One, it's expensive. So a ton of money is going to be going to fees. You're going to be paying a bunch of fees. You think it's going to your investment, but it's really not. It's just going to line the pockets of whoever sold it to you and the company. So yes, there are sometimes quote unquote, investment vehicles inside of these policies, but when you really break it down and you look at what you're getting charged versus what you're returning, it can actually take up to 20 to 30 years to break even and see any return. I had someone recently that works for one of those companies I mentioned that said, oh, they wanted to argue with me and said, oh no, our brochure says it's only 12. Okay, so your own company brochure is what's supposed to guarantee me, number one, but two, you're telling me it's going to take me 12 years to see any return on my money. That's absolutely crazy, not a good product, okay? And that was a whole life policy being sold to like a 23-year-old. Unnecessary, okay? If you're single and you have no children, you probably don't need life insurance, okay? So you shouldn't be buying life insurance anyways. Life insurance is to replace people's income if they were gone. For example, if you are a spouse and you're a homemaker and your spouse earns the majority or if not all the money, if they pass away, you don't have any sort of income to replace and take care of yourself, you need life insurance for that, okay? But if you're both working and you have a career, you may not need as much, or you may just need a little bit, or you may not need it at all. Also, if you have young kids, 2, 3, 4 years old, yeah, sure, you probably need some life insurance, but you don't need whole life, okay? But if your kids are 18, 20, 25, you don't really need insurance anymore because they can take care of themselves if you were to pass away, okay? It's not ideal, but if your budget's tight, for example, you don't need to be putting money into a life insurance when you should be putting that towards your retirement or your investments, okay? So even if you do need life insurance, there are many less expensive and more efficient ways to cover this need. So here's what you should do instead. Number one, build up a good emergency fund, okay? I see people buying these products because they want to, quote unquote, protect themselves, but a better way to protect yourself, because it's not very likely that you're going to pass away, okay, if you're in your 20s, 30s, or 40s. It's very, very unlikely. But it's very likely that you're going to face some sort of emergency within the next 5 to 10 years. And that could be broken down cars. That could be, something getting stolen of yours. That could be a lot of different things. So having that emergency fund there, usually in cash is good, or cash equivalents, is more important than spending all this money on a life insurance policy. So like it says here, investing doesn't make sense if you're going to take the money out for a small emergency. I would like to see you put your money in good investments like index funds or ETFs in your 401k or 403b if you're in a nonprofit world, at work, and in Roth IRAs. If you're not familiar with those, I did answer exactly what those are on my last video, which we did live. So if you want to get more detail, essentially it's just a group of stocks they put together in one big container, and usually they're very efficient, tax efficient, and low fees. So if you want to know more about those, you can reach out, but I don't want to spend time on that today. And if you do need insurance, okay, I recommend you buy some sort of term insurance, and probably 20 or 30 years, if you have a need. So that's if your spouse depends on your income, or you have kids that are young and cannot be self-sufficient without your income. And look at it this way. So we helped somebody recently on a pro bono case, and they're paying about $250 a month for one person to have $125,000 in one of these cash value policies. Okay, $250 for $125,000. So what we were able to do is help them out, and we got them $750,000, and it was less than $100, and that we got both spouses covered before only the husband was covered. So term insurance is so much better, and insurance and investment should be kept separate at that. Okay, you should never mix the two; they need to be kept separate. So term insurance is what's known as pure insurance, just covers you for a term. In all honesty, like 98 or 99% of people actually never use it because they outlive it. But the 1 or 2% that do, it really comes in handy if you have children or a spouse that can't be self-sufficient yet. So that's what I would recommend you do instead of buying one of these products. Okay. Let's talk about number 2. I see younger investors overpaying in fees like crazy. Okay. So every dollar you overpay in fees can actually cost you about $3 to $5 in retirement. Okay, so if you pay, $30,000 or $40,000 in fees, that could be anywhere from, $90,000 to $150,000 of retirement dollars you're giving away because you're overpaying. And I'm going to show you here where these areas are that a lot of people let these fees go. Okay, so typical fees you should avoid. Okay, so this is when you're looking at mutual funds. Okay, so index funds, mutual funds, and ETFs are all different variants of something very similar. Most people have heard of the word mutual fund. And so they know what it is. Essentially, it's a group of stocks. You can have an S&P 500 mutual fund, which means it has the 500 largest companies in the U.S. all put together in one fund, and that would be a mutual fund. But that also comes in an index fund or ETF that have lower fees. So mutual funds are the highest fee funds by far, but this is what's recommended for a lot of people that are just starting out. Okay, the problem here is that the typical fees that could come with these mutual funds are sales loads, and I'll explain what all these are, okay? 12b1 fees, expense ratios, redemption fees, management fees, account fees, I guess I have redemption fees twice, and purchase fees, okay? So these are all fees that are built into these things that you can avoid by sticking with an index or ETFs. Not all of them, but most of them. But the two that I want to warn you about today that I think are 100% preventable and easy to find for you if you were to look at your statements are sales loads and expense ratios. Okay? These are, like I said, easily avoidable. They're unnecessary for you to pay big expense ratios, unnecessary for you to pay sales loads these days. These funds were developed usually in the 80s or 90s when low-cost funds weren't quite as available as they are now. They're oversold and they're overpriced for 90 plus. I mean, most people, there's almost no funds that actually hold up to paying those fees. Okay. So, what are sales loads? So, a load is a fee that is usually charged up front or on the back of a mutual fund. It's essentially a commission that goes to the broker that you're working with. So, let's start with the types of mutual fund shares that are available so that you can check your statements and see if you're paying loads. So, very simply, if they recommend a certain fund, they get paid a commission, and I'm going to walk you through exactly how those work here. So let's talk about the types of mutual funds. So there's three shares, okay? Three classes of shares: Class A, Class B, and Class C. They all have loads, but the loads are charged differently, okay? So I'm going to walk you through each one of these. A shares. A shares have a front-end load. This means you'll pay a commission to the broker that sells you the mutual fund. It's an upfront commission. So, for example, let's say you invest $1,000 into a Class A share mutual fund. Well, if you were to do this and the front load was 5.75, which I literally am seeing like within the last couple of weeks, okay? This is not like old school stuff. This is happening. And this is being recommended by people on the radio. I love them for what they do with helping people get out of debt. But telling people to pay these fees is terrible advice, okay? So to put $1,000, if you wanted to invest $1,000 in a Class A share, you would put $57.50 would be going to your broker, okay? That doesn't seem like a lot maybe to get some help, but when you raise those numbers, you put some zeros on the end, it feels a lot bigger, okay? So say you wanted to roll over your 401k to an IRA, and the broker you're working with recommends you put money into your A shares, okay? And say you have $100,000 in this account. Well, then if that was the case, you would be paying $5,750 just for the opportunity to invest in this fund. That's right off the top. The problem is you may not even notice this or see this because they don't send your statements out for the first quarter. And so it has 3 months for the fund to go up and hopefully make some of that back. So a lot of people just aren't aware and they aren't really paying attention to this fee. But that's huge. That's a huge drop in what you should be investing. It's going to bring you down to about $94,250 is all you're going to actually be rolling over to invest. So that's tough. You're already starting negative almost 6%. So, and then every dollar you put in going forward will also be charged a 5.75% fee. To be honest, some of these funds do have breakpoints. So if you hit 100,000, 200, 500,000, sometimes these fees drop, but sometimes they don't. Okay, but you have to be aware that you're going to be paying this commission every time you put money in to these funds going forward. So this will have a massive drag on your investment returns. So you have to make at least 6% in the first year just to break even. Plus you're going to have other fees, which I'm going to show you as well. So you really need to make more than 6% in your first year. And that's not always consistently happening in the stock market, okay? So this is just one of the fees that can be involved when you're investing in mutual funds. So bear with me, and I will explain the other types of shares and expenses, but I'll also help you figure out what to do, okay? So let's talk about B shares. B shares typically do not charge a front-end sales charge like A shares, but they have a back-end sales charge. So if you were to sell them, you could pay that fee on the back. So the charge typically does go down the longer you hold the fund, but if you don't hold it for the deferral period, which is usually 6 years, you will have to pay a sales charge or a load up to 6%. Not good. B shares also typically have higher management fees, and I'll get to that in a second and what that means. But they also have higher management fees than A shares. So management fees are what you pay just to really own the fund, to pay the management company to do that. And I'll dig into that some more. Okay, so again, not good. And then many times asset managers, so the person that's actually managing your IRA or your portfolio, they'll want to swap funds out or rebalance the funds. There's things you can do where you buy more of another one versus selling, but this can also lead to big charges for you and commissions for the broker's pockets. Okay, so again, these are all things that you should be keeping, that should stay in there to be invested long term, that are getting taken out and paid out when you have these types of shares. Okay, then there's C shares. So C shares do not have an upfront sales charge like A shares, but may impose a fee, which is usually 1% if you sell the shares, and they also have typically a higher asset-based sales charge than others. So, which means that the fees just to own the fund are a lot higher. So C shares tend to be the most expensive type of shares to own the longer you own the fund. Okay, so this breaks down what loads are, how they're charged, and the different types of funds that have them. Hopefully that's clear, that you need to just stay away from these type, but this is probably what you're dealing with if you're dealing with one of these, these mutual type companies or somebody who's not a fiduciary. The way these funds were originally sold and still are is by getting people to believe that the broker's recommendation of these crappy funds can somehow pick magical mutual funds and will outperform the market. This is the thing that just gets to me, that one of the biggest radio hosts has like 500 plus stations. I don't need to say his name. You probably know who he is. But he says these brokers can pick these fees or pick these magical mutual funds that are going to outperform the market, quote unquote. Okay, let me bust that myth for you. There is absolutely zero evidence that this is the case. There is Nobel Prize winning research on this subject, and the results are very, very clear. At least 85% of actively managed funds do not outperform their appropriate benchmark over any given time. And of the 15% that do, statistically, they're very unlikely to repeat their success over the next time period. So what that means is, if someone had a good run, these 15% of funds that beat quote unquote their index or their indices, they are pretty much have zero chance of doing it again. Okay. And that's what research says. So studies have shown that up to 96% of actively managed mutual funds do not outperform their index. So paying a broker nearly 6% upfront commission with a 4% chance that fund will outperform is ridiculous. I really just don't see that as a prudent strategy. For really any investor, most investors, 96% of investors is not a prudent strategy. So I would rather have you take the 96% chance that you're going to capture at least the market returns, keep your fees low, and focus your energy on putting more money in versus worrying about paying more commissions to a broker. So what should you do instead? So again, bear with me. I'm going to give you the answer after I cover my next couple points, okay? So next thing you need to be concerned about when it comes to fees is expense ratios. So expense ratios are the amount you pay essentially to own a fund to the fund company. If you see that, if you pull up your statement for your Roth IRA or 401k, you'll see an expenses section, and that's your expense ratio right there. Usually it's somewhere, it'll be, some of them are low, 0.25, but many will be like 1.25. I've seen 2.25, a lot of different things up that high. So you need to look at those, okay? But just to be clear, all mutual funds, index funds, or exchange-traded funds, which are ETFs, they have some sort of expense ratio. They all have that to manage. But it's simply the fee the fund manager charges to manage the fund for you, so you don't have to deal with it, okay? And it's definitely worth it if you're paying one of the low fees. It's just that some are higher than others, significantly higher in many cases, okay? So let me go back to the different types of mutual funds I just went over. Many of these types of funds, the A shares, B shares, and C shares, have over 1% or many with 1.25% or higher in fees. So that's on top of the load you're going to pay. You're going to have to pay this, 1.25, 1.5% fee on top of that, and that's every year. if you think 1% doesn't seem like a big deal, let me put some of these numbers together for you. So say you buy an A-share mutual fund and you pay a 5.75% commission, okay? So you pay 5.75% just to buy in. Then in the first year, you have to pay a 1.25% fund fee, just ongoing expense. Then the financial advisor you're working with adds their fee on top, which is typically 1%. So that's, actually that's 8% you could be paying within the first year. 5.75 plus 1.25 is 7, plus another percent for the financial advisor. So that's like an 8% you could be paying in your first year. That can get very, very, very expensive and really, really drag down your returns and what goes to your pocket long term. And it's just not necessary anymore, okay? It makes it very difficult to beat any of these low-cost funds, so like ETFs, index funds. It's almost impossible. You have a 96% chance you're not going to beat it, okay, when you're paying fees like this. So let's compare that to a low-cost index fund or ETF. So I'm going to talk about a company, Vanguard. You may have heard of this, you may not, but they're wonderful. We use them in my practice. I love their funds because the investor gets to keep most of their money. But they're also known for having very low cost but very high quality funds, okay? So, for example, they have a fund called the Vanguard 500. This is not meant to be investment advice. I'm not telling you to invest in this, but I'm just using it for an example. So the Vanguard 500 fund is simply mimics the S&P 500, so the largest 500 companies in the U.S. And that fund has no loads, so you will not pay 5.75%, and it has only a 0.14% expense ratio. So not 14%, 0.14. So if you compare 0.14 to 1.25, that's almost 10 times less expensive than owning, one of these expensive mutual funds. And that's just on the fund management fee, let alone the 5.75% upfront. So again, this is all money that's going to your pocket. It's all going to stay in your investments, and it's going to be your return long term. Okay, so this is what we recommend doing, is going with index funds or ETFs. Like I said, it makes it very difficult for any fund that charges 1.25% per year and an upfront load of over 5% to compete after fees. Okay. Number three reason that Gen X and Gen Y investors really don't end up wealthy or really feel like they end up struggling later is that they fail to get started. A lot of folks get started, then they get to these companies that essentially rip them off. Or there's a whole other group that just fails to get started. They either don't know what to do, they feel like they don't have the money to invest. But in all honesty, when I sit down with folks and we do a really tight cash flow plan, I can almost always find money for them to invest. Okay, but the analysis paralysis of what do I do, where do I start, what do I do first, that really holds a lot of people back. And it's probably the biggest barrier that you will face to becoming wealthy at a young age. I'm seeing a lot of folks that got started in their early 20s and they're in their late 30s now, and they have a few $100,000 already saved up, and they're in a very good position because they got this information early. So it doesn't matter what age you are at, I want you to get this information early and start acting on it now. Okay, let's get started. Okay, so so many people never take the time to make saving and investing intentional. Or all they do is set up their 401k and they put 5% aside or whatever they get matched, and that's all they do. And they say, I'm maxing out my 401k. Well, okay, maybe you are maxing out the match, but unless you have a super high income, you could put up $18,000 in your 401k and it's going to be $18,500 in 2018. So unless you're putting $18,000, you're not maxing it out, okay? Putting 5% and getting a match is great. It's a good place to start, but it's not enough. You need to be putting at least 10, 15, 20% of your money aside. And I know that may seem crazy right now, okay, but over time, if you do the things that I will teach you through these trainings, you will be able to do that, okay? So what I want you to do is make learning about investing a priority. Okay, it has to be very important to you. You have to make it more important than going out on the weekends. You have to make it more important than being flashy in front of your friends with some fancy car. You got to get these things started now, okay? It's really, really important. And the earlier you get started, the easier it is to hit your goal. Simple as that. Also, the earlier you get started, the less percentage of your income you have to save due to compound interest. So if you're not familiar with compound interest, highly recommend you Google that term. It blew my mind when I first learned about it. But essentially what it is when you invest money, you earn interest, okay? So say you invest some of your money this year and you earn 10%. Well, the next year, if you earn another 10%, you earn 10% on your original money you put in, plus you earn 10% on the interest that you earned from the year prior, okay? So interest earned on previous interest is called compound interest. And that is what what's his name? Albert Einstein. Albert Einstein said compound interest is the eighth wonder of the world because it's absolutely insane once it starts really kicking in, but it does take a little bit of time. So the earlier you get started, the better. So if you're starting at 21 when you're first getting out of college and you got your first job and you're putting 10% away, you might only need to save 10% for the rest of your life, okay? But if you're starting in your 40s, or 50s, you're going to have to save 25, 30%, maybe 40% to be comfortable in retirement and not rely on, other sorts of outside assistance, okay? So the earlier you start, the better. So I hope you took some good stuff away from this. I hope you learned something today. If you found any value in this, if you would just like this video or share this video, it would mean the world to me. I'd really appreciate it. I just want to get this information out to as many people as possible. I'm truly passionate about helping out young investors and older investors as well, people going into retirement. But I really want to help you get started, okay? So if you have any questions, this is my information here. You can reach out to me if you like. I'm on Twitter, Instagram, my Facebook page, which this is on right now, but this may get shared somewhere else, is all here, okay? Or you can email me directly at jason@KIS Planning. KIS stands for Keep It Simple. My firm is called Keep It Simple Financial Planning, and I help two types of individuals, folks going into retirement, so less than 10 years, and folks getting started, okay? I really love to help people that came from low to moderate income backgrounds because that's where I came from, that figured out how to make a really good income, but they're just not sure what to do. Maybe their parents never taught you, and I love helping people out like that as well. And that's what I did this presentation for today. So if you need help, reach out, but I just want to get you this information, and hopefully you can learn something and you took some things away and that you go look at your own investments and start optimizing those so that you can keep more of your money, all right? Hopefully you guys like that. If you have any questions or comments, feedback, leave it for me. I would love to hear from you. I want to be doing these trainings more often. So what I would like you to do, if you can, is go to my page and turn on the notifications so that you get notified every time I do these live. And the replays will be here as well. But I would love for you to get these live so that you can watch with me, ask questions, and I can answer them for you live, okay? I know this was out of the blue. I just put this on. I just felt like doing it. I didn't want to wait. So, all right, guys, I appreciate you. If you watched this far, I super appreciate you. It means so much to me. Thank you so much, and I will be talking to you guys soon. And let me figure out how to turn this thing off, all right? Let's see.